Yeah, so firstly, thank you very much for taking the time out on a sunny Sunday evening to be with me here and learn about accounting, tax, limited companies, and so on. So in this webinar, it's going to be quite broad. In what we're going to try and cover a little bit of a lot. In that, we're going to run through kind of how to set your company up, some key errors that we see people make, and also how limited companies are taxed, what kind of forms need filling in, and essentially busting through all of the jargon that you see at Companies House, so you know exactly what the information on Companies House actually means. And on top of that, we're going to run through some key tax basics, so what expenses you can claim, directors' loan accounts, and quite a bit more as well. So what we'll do is we'll just get stuck straight in now and take things off. So the first thing is, introduction to limited companies. So a limited company is the most common structure for tax reasons at the moment. Plus, you've got the limited liability benefit as well. The reason for this is a limited company is a completely separate legal entity. So if you're trading in your own name or a partnership, that you can be personally responsible for any wrongdoings, any debts of those. Your assets are personally at risk. Whereas with a limited company, unless you put a personal guarantee in place or you've done some serious wrongdoing, you do have the benefit of limited liability, which means your personal assets are safe. A limited company has directors, and these are appointed by the shareholders. A director's job is to manage the business. They've got directors' duties, which they must adhere to, and they are actually separate from shareholders. So a shareholder doesn't have to be the same as director. A shareholder's role is simply that they own shares in that business. But for quite a lot of small and medium-sized entities, the directors and shareholders are the same people. And a lot of this information is available publicly. So a limited company, each year it must file annual accounts. These go to Companies House and HMRC, and it must also file a corporation tax return to HMRC, a confirmation statement, which goes to Companies House. And a question we get asked a lot is, with a limited company, is it April to April? Is that the tax year? Well, a limited company has a financial year of its own, which is roughly 12 months from when the company was set up, incorporated, unless you've actually changed it yourself or extended the year. A limited company pays tax at 19%, corporation tax at 19%, and the corporation tax return deadline is 12 months from the end of the accounting period. So if a company year end is 31st of December 2019, the corporation tax return must be filed by the 31st of December 2020. The tax must be paid 9 months and 1 day after the year end. So in that above example, the corporation tax return must be paid by the 1st of October 2020. So I've always thought it was quite strange that you've actually got longer to prepare your corporation tax return than you do to pay it. So in essence, unless you actually prepared your return by that deadline, there's a bit of guesswork as to what amount of tax needs to be paid. And it's the same with accounting, that you must prepare compliant accounts each year. So they must be prepared under the financial reporting standards, which is a bit of accountancy jargon, which is basically rules that determine how things are accounted for, the presentation of the accounts, just to make sure that all limited company accounts across the UK are kind of similar to one another. Yeah, so any questions, just pop them through and we'll cover those at the end. Perfect. And the accounts must be filed 9 months from the end of the year. So with that previous example of the 31st of December year end, you would have the 30th of September 2020, which is when those accounts must be filed to Companies House by. A confirmation statement is due 14 days from the end of the accounting year when the company was set up. A dormant company. So a dormant company is different to a trading company. A trading company, you have to do the full accounts, the corporation tax return. Whereas a dormant company, which means that you've had no money in or out of the business, it's just not traded. You might have set it up to protect the name or for a business that you've just not got around to starting yet. And what the difference here is that a dormant company does not require full accounts. So you can prepare dormant company accounts, which are very easy to file. They'll probably take 30 minutes maximum if it's the first time doing them, and they go straight to Companies House. There's no requirement to submit a corporation tax return, as long as HMRC are aware that your company is dormant. If, for whatever reason, they think, if they've already sent a CT 600 out, they are expecting a tax return, and as a result, you must inform them that it's dormant.